Week. Let's bring in Goldman Sachs chief economist and head of global investment research, Jan Hatzius, as always here on a jobs day. So what did you make of that? You must have been surprised. You expected 160,000 jobs to be added. Way higher than that.
We were surprised in part because we thought that the spring hiring season, which expects a decent amount of jobs to be added, in the seasonal factors expect a decent number of jobs to be added, but actual hiring actually blew past that. And so, yeah, it was a surprise. Overall, it's a stronger than expected report, though if you look at the household survey, I think the takeaway is that we can add a lot of jobs and nevertheless have the unemployment rate go sideways or even a little bit higher. So the break-even pace of payroll growth is very high. I do think that has a lot to do with the strong immigration trends. Immigrants coming into the workforce, and we're rebalancing the labor market even with very strong payroll growth.
Can you just explain this discrepancy between the household survey and the non-farm survey? Because they're measured differently. We always include both of them. Household includes more, like people who are on leave, who are not getting paid. Can you just explain how this happens and how we get such a gap here?
Yeah, one is a survey of firms, one is a survey of households. The survey of firms is much bigger, so the sampling error from month to month is smaller in the establishment survey, payroll survey. Mm-hmm. This is why the payroll survey typically gets more weight in the way that markets look at employment. The household survey is valuable, but you typically have to average a little bit more. You don't want to put too much weight on a month-to-month move. So I would look at, for example, the increase in the unemployment rate that we've seen over the past year, about half a percentage point. I think that is a real signal that the labor market is less super tight than it was a year ago. I wouldn't necessarily put a ton of weight on the latest month-to-month move.
But then what's with that wage number that accelerated more than expected, 0.4% on the month?
Well, the wage number comes from the survey of firms, and again, it can move around. I do think it's a signal that yes, wage growth is still pretty strong. And
is that a problem for the Fed?
I think if you saw 0.4% month after month after month, that would be a problem. The year-on-year rate has been very gradually coming down. It's low fours. That's consistent with some of the other indicators. That's probably still a little high. We were at 5.5, so we've come down, but I think they probably want to be somewhere in the mid-threes.
What about the labor force participation rate? We were talking about how we saw a decline. So the move up in the unemployment rate can't be explained by more people coming into the labor market. What do you think is happening there?
Well, it was a weak household survey, and you can see that in the increase in the unemployment rate and the decline in labor force participation, if you just take the month-on-month changes. Again, though, I would caution against putting too much weight on a month-to-month change in the household survey. It's a pretty small sample, and it can move around quite a lot. But yes, the data point was softer.
You mentioned wages. Some discussion today about how wage growth in Europe is a liability perhaps for the doves over there. Is it? And how long can Canada and the Swiss and the EU move ahead of the Fed?
I think that's right. We've seen stronger wage numbers in a number of places. The Canadian numbers were also a little bit stronger on that score. I think, they have taken the view that their outlook is for the economy to get back to a 2% inflation environment. And they're a little bit less responsive to the latest wiggles in the numbers than what we've perhaps seen in the U.S. The latest inflation numbers in Canada have been low, but the latest inflation numbers in the euro area have been on the high side. And nevertheless, the ECB went ahead with this rate cut, and we expect them to continue to go ahead, not in July, but we do expect another cut in September.